Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. Many of you know me as Mr. Valuation. That's kind of germane to this particular video because what I'm going to talk about is growth and value. You know, typically in Wall Street, when you hear the subjects of growth investing or value investing discussed, it's usually discussed separately. It's either value versus growth or growth versus value, as if one is contra or against the other. And that's really a pet peeve of mine because frankly, in my view, if you're talking about investing, whether you're investing in growth stocks or dividend paying stocks or bonds or anything else for that matter, real estate, etc., to me, you can only utilize the word investing when value is associated with it. Anything that isn't value, quote unquote, investing is speculating. And there's a fundamental difference. I've gotten a lot of heat and feedback. I talk about my favorite stock on the planet, Apple, and I talk about how it's overvalued, how much I like the company, how impressed I am with its business, etc. I'm just not going to buy it at these prices. That would put me as the greater fool, where I'm foolishly paying more for even my favorite stock on the planet, simply on the basis that a fool greater than me is going to come along and pay more. I want to have fundamentals underpinning all the investments I look at. But rather than think of it as growth versus value, as if there's a contest going on, I like to think of it as growth and value, because to a great extent, value and growth are actually joined at the hip. Almost every stock grows. The difference is how fast they grow. Utility stocks, for example, tend to be very slow growers. Tech stocks tend to be much faster growers. But there's always growth associated with it, and here's the important part. When you're talking about value, value is functionally related to growth. In other words, the future growth of the stock is going to be a major component of how you actually calculate and assess whether the stock is trading at fair value or not. So I see the two as joined at the hip. So let me go ahead and move in and talk about the seven. I've put together here 10 stocks that have the attributes of both growth and value. And I'm going to go ahead and go through this. I call these research candidates because these are not stocks that I'm necessarily suggesting that you invest in today, but they are stocks that I think you can consider. Now, here's the deal. This is the S&P 500, through the lens of FastGraphs. The orange line on the graph is a PE of 15. The blue line on the graph is simply another valuation reference that kind of calculates how the market has valued the stock historically on average. But the point is, when you're looking at these lines, you can see when it's above the blue line, the PE is higher than 17. When it's below the orange line, the PE is below 15. When it's touching it, it's approximately on the 15, or it'd be approximately on the blue line of 17.5 or 6 times earnings. And of course, you can see the S&P is very, very highly overvalued now. So what I said was, I want to talk about growth. Now, to get a little more detail into this, if I'm really talking about growth where I'm looking for total return, capital appreciation, then I start to define growth. I like to look at stocks that are growing by about 15% or less. In today's world, that's very hard to find, so you can adjust that a little bit down to about 10% or better. Okay, so I'm looking for companies that have double-digit growth, let's put it that way. And so the screening criteria I utilized for this video was I looked for companies that were growing at 10% or better, estimated future growth I'm talking about. I looked for companies that had earnings yield of at least 6% because that gets me in my value criteria. I prefer higher than 6, but 6 was my minimum. I'm looking for investment grade companies, so I limited it to BBB minus or better. And then in this particular screen, I also wanted the stocks, every stock that I showed you, to pay a dividend. So when you've got this very highly inflated, marketplace here, it was very hard for me to come up, but I was able to come up with 10 stocks that I think would make excellent research candidates that have, good long-term growth potential, or at least over the next 2 to 3 years. So, these are the 10 names. I'm going to be covering them in the video. The estimated growth, you can see all of them are above 10%. They all have credit ratings above BBB minus. They all have earnings yields of over 6%. Now I can sort these. You can see the lowest is Anthem at 6.1%. The highest would be Equitable Holdings with an earnings yield of 14.97. From a growth point of view, if I put them in order. Citizens Financial has the lowest estimated growth at about 10%, and BorgWarner would actually have the highest growth forecast of about 18.35%. Growth and value are joined at the hip. Now, I've got a pretty diverse 10 group of companies here. Now, as far as GIC sectors, financials dominate. There's an awful lot of financial stocks that are, reasonably priced today. But even in the financials, I've got diversification. A lot of people get confused. I've got a regional bank. I've got Diversified Financial Services and Equitable. They're famous for their Bernstein mutual funds. You might know them by that name better than Equitable Health. And then I have JP Morgan, which is a big money center bank, and then LI Financial, which is actually consumer finance. So even though they're all financials, they're different. Same with healthcare. I've got McKesson, which is a healthcare distributor, and then I've got Cigna, which is healthcare services, and you get the drift. So I've got some good diversification here. These are 10 stocks that you can look at for growth. Now, what I'm going to do is I'm going to go through these, and I'm going to utilize the new version of Fast Graphs. And what I'm trying to do here is just give you some upgrades. It's been very frustrating for us. We're trying to get this launched. We want to make sure we launch it correctly. One area that I do have working pretty well is the classic Fast Graph, the historical Fast Graph, as well as the forecasting tool. And we just made some enhancements on our performance section as well. So we're getting closer every day, guys. And, we're looking forward to bringing this out because one of the advantages is speed. But we'll talk more about that. I'm going to actually show you the speed as I go through these stocks. So let's start with Anthem. This is a stock I've talked about, quite a bit. It has a blended adjusted earnings yield of about 6.16%, moderate dividend yield. But the dividend growth record, which they've only been paying a dividend, I want you to notice, since 2011. So when I do performance and focus on the growth rate of the dividend, the average growth rate's been about 16.59. The compound or CAGR average growth rate has been 15.999. So roughly 16% dividend growth. I think that's the important factor here. As far as going forward, if you look at this stock, and I'm only going to look at this through 2023, by the way, that's where I'm limiting it. And like this just is a part of the tool that we don't have dividends plotted there yet. So I'm going to go out to 2023, which is as far out as I want to go. And I'm looking for stocks here when I did this screen, candidates that could give me a 10% rate of return. Now, what that 10% rate of return is based on is a forecast growth rate of 13.34%, which qualifies it as a 15 multiple or PE ratio, which is what the orange line is. You'll notice on the graph here. And that goes out, if the stock traded at a 15 PE, and that would, give me a little bit of PE contraction because the current blended PE ratio for this stock currently is about 16.22, okay? So what I'm saying here is this is fully valued, not necessarily undervalued, but it's a very high quality company, A-rated. I could generate a 10% rate of return going forward. So my first research candidate here is Anthem. And I don't have these in any particular order. My next one would be BorgWarner. Now, BorgWarner is a little bit cyclical. Of course, it's auto parts and equipment. You've seen their products, I'm sure, in auto parts stores, etc. I do want you to note that the historical growth rate of this company has been about 9.74. But if I shorten this time frame significantly, it does get me above my 10% threshold that I'm looking for. From a standpoint of forecasting, it does have a nice forecast growth rate of about 16.5%, but that's going out almost 5 years. If I limited it to just 2023, it would be closer to 18%. But if I bought this stock today and it traded at a PE ratio of 16.5, and here I'm using the P equals growth rate formula. So the orange line in this example would be a PE of 16.5. That would indicate over the next 2.5 or 2+ going on 3 years, I could generate an annualized rate of return of 25.77%. Growth and value are joined at the hip. This is looking at a stock that would technically be classified as a growth stock that I can buy at an attractive value. And that's the message I want to keep getting across here. Now here's Equitable Holdings, which again is a diversified financial services company. Once again, the stock is very inexpensive. The PE is only 6.68, and it's got almost a 15% earnings yield, which is very, very strong. If I look at this going out to 2023, and it did trade at a 15 PE ratio, which I would consider, fair value for this stock, then you'd be looking at making almost 50% rates of return. If this traded at its normal multiple, which has been, significantly lower, then you might be looking at a much lower rate of return. But the point I want to make is I believe this stock is, should be trading at a 15 PE. So this one would have an element of speculation involved if you were going to consider Equitable. It's just so ridiculously inexpensive, has almost a 2% dividend yield, and you can buy it for less than 7 times earnings. That's pretty incredible if you believe that stocks, will eventually revert to the mean. Citizens Financial is another financial. This is a regional bank. It's got very strong earnings forecast for this year. The company, again, is BBB plus rated, offers about a 3.37% current yield, which is one of the highest in the group here. But if I go out to 2023 again, I do want you to note that, this has double-digit 15% plus rates of return. But I always want you to see where these returns are coming from. The majority of that is based on the strong forecast for this year, followed by some weakness and then recovering back to approximately a 10% growth rate again. If I look at the company historically, there is, a certain element of cyclicality that's been involved with this company historically. But again, it's BBB plus, reasonable debt levels, real nice dividend yield, earnings yield of about 6.5%, trading at a 15.5 PE ratio, but strong growth expected for this year. The next one would be JP Morgan, which all of you, I'm sure are familiar with, A- rated. I've got a 6.67% earnings yield, which is precisely a 15 PE, 2.75% dividend yield. If I look at this company going forward based on its expected growth out to 2023, I would only have about a 7% return if it stayed at this low multiple. But if I went and looked at it from a standpoint of what I would consider to be fair value, which would be a 15 PE, you stand to make double-digit returns of about 12.27% going forward. I want to mention this blue line concept. You can see there are times when the stock moves back into a 15 PE as it has now, but financials, ever since coming out of the Great Recession, financials have traded at sort of a discounted valuation. I do want you to note that, between the last 2 recessions, a 15 PE, which is the orange line in this graph, was quite common for these financials. And you can see it does have a penchant for moving back towards that PE line as it is right now. So I believe, a 15 PE would be the proper valuation reference to utilize for JP Morgan Chase. I think it's an excellent candidate here. The next example would be McKesson, which is a healthcare distributor. This is a company that's historically always traded at a 15 PE. It's had 13.77% historical growth. The current PE is under 11. All that has to do with, what we saw with the opioid pandemic, et cetera. These stocks all seem to be recovering from that. If I look at it out to 2023, like I have with everything else, and go out here, then I'm looking at a 30% annualized rate of return. This would be a function of the PE ratio going from the current 10.8 up to a more rational or more normal or a fair value, intrinsic value PE of 15. This stock has a very, very nice margin of safety in it relative to some of the others I've shown you here, which is one reason I like it. The dividend yield is light. It doesn't pay, the payout ratio is very low. But as this company grows, the dividend payout ratio could easily expand. It already has expanded from when it first came out with, a single-digit dividend payout ratio. Now it's up to a double-digit 11% payout ratio, and that could go significantly higher in the future, which tends to happen with dividend-paying stocks over time. The next is Air Lease, referred to as a trading company, but Air Lease is a very interesting company. They lease aircraft for commercial use, etc. The company's forecast growth rate in this example is about 16.46%. So using a 16 PE ratio going out to 2023, this stock could generate 35 to 40% annualized rates of return. The stock has a dividend yield of 1.3%, an earnings yield of 22.52%. That's extraordinary. The company's BBB rated, but again, I think this stock is worth a 15 PE. It's out of favor right now, but I do also want you to notice that just in the last few years here, or you might say year or so, this company's really had some really good performance. It looks to me like it's moving back into alignment with its intrinsic value. The next one is one that I've talked about before. Now, Cigna is starting to pay a $4 dividend. They used to pay a very minuscule dividend, but now the company's getting a little bigger, and they're going to be increasing their dividend to $4 a share, and that will give you a much higher yield than what we're currently showing on the graph. So that's something to look forward to. From a forecast point of view, the company is expected to grow at around 12% a year. This means that if you bought the stock today at a blended PE ratio of 13.09 and an earnings yield of 7.64%, I believe this would be a very attractive candidate to look at. The company's A- rated. I like this one very much, and I think it would be a great candidate for growth and value, not growth versus value, but growth and value. Remember, that's the theme. Jabil Circuit, which is a St. Petersburg, Florida-based company, kind of a hometown company. A little bit cyclical, but it's a tech stock. It's expected to have very high growth this year, followed by 7% and 7%. It all averages out to about 14.78%. This would, give you the opportunity to generate almost a 25% annualized rate of return if it reverts to the mean and gets back to the 15 PE ratio, which this company has historically traded at many times. So that's another case of growth and value. Here's a consumer finance company, Ally Financial. You can see it's expected to have a strong growth rate, which, makes a lot of sense considering what's going on with interest rates and investing today. Looking at the forecasting calculator here, we're looking at over 100% earnings growth, which is recovering from COVID. So we're looking at a 14.3% average growth rate going out to 2023. That would give us the potential to make over 30% annualized. So again, 1.5% dividend yield, which is close to market neutral. The key element here is that these stocks are growth and value stocks. They're not value stocks. They're not growth stocks. They're growth and value stocks. And again, to reiterate, I believe that all investing has to be considered value investing. Now, you can invest for value and growth, okay, but if you're investing in growth stocks and you're paying extraordinary valuations for them, you're speculating, you're not investing. If you want to call it investing, you've got to apply the principles of value and look for fundamentals supporting your investment, because in the long run, that's how you're going to win. Anyway, hope you enjoyed this video. It's Chuck Harnwell saying thanks for watching. Give me a like, ring the bell, subscribe to the channel, give me a thumbs up, do all those nice things for me. I appreciate you as always, and look forward to talking to you again very soon. Thanks for watching.